Welcome to the Inside Track on Real Estate with the Dekker Team. And I'm Ken Dekker, and today I got a special guest who usually once a month or once every second month I get to talk with Lynn Fraser from More Than Enough. And Lynn is a excellent mortgage broker and financial coach.
Thank you.
Yeah, and so you may have even listened to some of Lynn's shows, which air right before my show.
I know, I like the way that works. It piggybacks well.
Yeah. So today, Lynn, we're going to talk about a few varied things. Let's talk about what changes are coming down the pipe on the mortgage industry, because what I've found that is in the last several years, the only thing that's consistent in the mortgage industry is change.
Oh, it's huge.
Yeah.
It's huge. There have been many changes made already. Really, at the bottom line is that the government is trying to slow down the borrowing on houses. And so
well, they slowed down the real estate market. They did that.
Yes, they have done that, and that was on purpose. Why? Because of the low interest rates, people were borrowing, and in some cases they were concerned that they were over borrowing.
Okay, fair enough.
And the fear is that if increases come in the interest rates, and inevitably they will. We are at the lowest interest rates in history, have been for some time. Mm-hmm. But the concern is that if the interest rates increase, that people will not be able to afford their homes. Right. So rather than increasing interest rates so far, they have changed the rules to reduce what people can buy.
Right, and so one of the concerns is that we thought with lower interest rates, people would be borrowing less money. But with them so low, it's almost like free money. They think it's almost free. And so our borrowing has actually gone skyrocketed.
Crazy.
And government borrowing and personal borrowing.
Yeah. Well, that's what you and I have in common. It's one of the things, is that we're very concerned about stewardship and good stewardship. And we're very concerned about people's debt loads and the lifestyle that they're called to and living the life they're called to. Mm-hmm. And so we don't want their home or their borrowings to be an impediment to live out their life on purpose.
Right. So tell me a little bit about what's called B20 rules. There's some more
B20
changes?
rules, okay. Yeah. Those are some of the government regulations that are being imposed upon financial institutions so they cannot overlend.
Okay.
So some of the changes that we've already seen is a reduction in the amortization schedule. So now, instead of being able to borrow a mortgage over 40 years, it reduced to 35, 30, and then 25. Although there are still 30-year mortgages available if it is not CMHC insured.
So they'd have to have at least 20% down?
Yes.
And then they could get, but if you have that much down, why would you go to a 30-year mortgage instead of 25?
Yeah, you and I would generally not want to encourage a longer mortgage. We want to encourage a shorter mortgage.
Maybe on an investment property that you wanted cash flow, but other than that, I wouldn't think so.
Yeah, so you don't want false affordability. You want affordability that's going to last, right?
Right, okay, and so that's putting the downward pressure on real estate because, well, A, we've got a lot of inventory, but B, the interest rates are still great, and yet people were buying more house than they could with a 40-year amortization. They could buy more house because their payment was lower than they can with a 25-year amortization, but it was creating more and more debt.
Oh, huge. I mean, if you were buying on a 40-year mortgage, 5 years later, you could still owe almost what you started with.
So the only ones really making a big buck on that are the lending institutions.
Uh-huh.
Okay.
And they like that. But the government said, okay, we can't raise interest rates right now because people are so heavily in debt.
And the government owes too much.
And the government owes too much, yeah. So nobody can afford higher interest rates. So instead, to slow things down and prevent people from overborrowing, they made it more difficult to borrow that much. One of the things that's coming now, as of September, is the change in how they treat other debt other than the mortgage. So in the past, if you had, let's say you had an unsecured line of credit, so just your standard line of credit with the bank, not secured on any property, and you were paying interest only on it, right? Because some financial institutions only required that you pay interest only. If you had a $30,000 limit and you had $10,000 owing, you might only be paying $75 a month.
Okay.
And so the lender would take that into consideration in what you qualified for on your mortgage, in your ratios. Now, they're saying, no, we're going to do our calculation based on what you could borrow and not on interest only. So if you have an unsecured line of credit of $30,000, even though you only owe $10,000, they're going to treat the payments as if you fully use that line of credit. Means that you're going to qualify for a whole lot less. That payment may be considered at $900 now.
$900 compared to $75. So that's affecting $600 of money that you now can't get a mortgage for, right? That amount.
Yeah, exactly.
And $600,000 is, or $600 a month is close, a little over $100,000, right? So you're going to be buying a house that's worth $100,000 less.
Yeah, or
on that approval.
Or you cancel your line of credit.
Right.
Or you close some of your credit cards. Like, credit cards are treated in the same way.
Which is not a bad thing.
No, it's a great thing.
Close off some of that personal debt stuff. Because personal line of credits that are unsecured and Visas and MasterCards and all that, it's generally consumer debt that goes on those things.
Yes.
It's not investment debt. It's not housing debt. It's debt on stuff that goes down in value, is consumed over time. So that's probably a good thing. I like some of the changes the government's making.
I do too.
And it's making it tougher for people to buy homes.
I do too. I like them. Particularly, there's not too many people that think like you and I do, Ken. Most financial institutions, real estate agents and mortgage agents are going to want people to buy the maximum because that's where they make the most money.
Right.
But that's not how we roll. Our objective is always, and that's one of the reasons that we work closely with the Dekker Team, or the Dekker Team works closely with us, is that we're concerned about good stewardship.
Right, and protecting our clients from making a mistake, which may be very costly down the road when it starts affecting their lifestyle, their ability to give, their ability to have a life. Really, we don't want them to be house broke.
Exactly. One of the things that we do with every client that comes into the office is we say there's two numbers that we're going to give you. One, what you can afford, and the other is what you qualify for. But we're going to focus more on what you can afford, because there's no point in buying something that you qualify for and then not be able to live in it.
And even the qualifying percentages have come down, right? They were up as high as like 42%.
44
total,
in some 44. cases, yeah.
What's that down to now? 38, 36?
No.
No?
No, there's still some 42s, some 40s.
Okay.
But considering how they treat the other debt now,
it's making it harder.
It's making it much harder. In the past, you could borrow your life away, really, and so that you couldn't afford to live life. One of the challenges, one of the strategies that financial institutions employed, whether intentionally or unintentionally, is that they lent people so much money. No, I won't say it's intentionally. That's cruel. But they lent money knowing that it was the max that they qualified for. And of course, we're speaking primarily to a Christian community because we're on CHRI. And that certainly didn't take into consideration any room for giving. But knowing that over the next 1, 2, 3, 4, 5 years, they were probably going to increase the balances on their lines of credit or credit cards to live in the house that they just bought, or to do the improvements or all of the upgrades and all the new furniture and the things that they would do. But really, they didn't understand that at some point they were going to hit a wall.
Right. So unless their income was increasing, which not too many people have had large pay increases in the last many years. So unless your income was increasing, they were in basically quicksand. Yeah. Because to continue their lifestyle that they were on, they would have to dip into the line of credit or whatever, and then that became a slow thing that actually grabs them until it's too late. And
that talks about another rule, because one of the ways that people dealt with that is that in 3, 4, 5 years' time, they would refinance their home and pay out that consumer debt. So they would reborrow against a house because it had accumulated equity,
So they're using it as a giant ATM machine.
They were.
And which works, well, it doesn't work. It's not a good idea, but it works in that real estate was increasing at 6, 7, 8% per year. So the equity was going up and they could draw it back out. And I think what the government's worried about is if we don't keep getting equity increase in housing, or it stalls or even goes down a little bit, now suddenly that person's in trouble because they don't have that safety valve, break glass in emergency because they don't have the equity in their house.
It's because they haven't been listening to us either. That's their biggest problem, Ken. They haven't been coming to our workshops and listening.
Okay.
But and that talks about another change that they've made, because in the past you could borrow to 95% of your value on a refinance. So you could, if you wanted to do a consolidation mortgage, you could borrow up to 95% of the current equity, and that dropped to 90, 85, and now it's down to 80%. So you cannot refinance to the level that you once could.
Which is a good thing, again.
I agree.
And yet it's something that people may have become accustomed to, and they're going to get a shocker if they've been living the wrong way.
Yeah.
Yeah, okay.
So I think one of the things that the people are listening today should be aware of is that there are more changes coming in September. So if there are some people that have already made some decisions about making a move, or have kind of been sitting on the fence, it's certainly easier to do what you want to do today than it will be in September.
Okay. So does it have to close before September or just be sold firm before September?
You know what? I was going to. It depends, right?
Okay.
I think it's somewhat dependent on the lender.
Okay.
So some lenders will honor what was approved prior till September 1st, and some will just shut it down and say no.
Ooh, that could be dangerous. If you buy a house, so you better qualify today at the standards that are coming out in September.
Yeah, most lenders are already doing that. There are
Okay.
some lenders that are still giving people the option to qualify higher. So.
Yeah, okay. And Lynn, one of the questions I get quite often is, and you probably get it a lot more because you're in the mortgage business, I'm in the real estate business, but people will ask me, do I lock my mortgage in? Do I get a 5-year? Do I go variable rate? When would I use each? Is there that much difference between the rates? And so what's going on right now with that discussion?
That's a discussion, you're right, that I have every day. In fact, we ask our clients, one of the questions we ask is, what is your tolerance for risk? Because first of all, if you have no tolerance for risk or low tolerance for risk, variable rate's not for you. That's a really good way to look at it, because there's always potential for that to change.
Yeah, and they've been, I think, low for so long, people are lulled into a false security that they won't go up.
I know. Like an average interest rate is closer to 5.5%.
Okay.
Right? And so, and there was a time when 5.5% was awesome. I remember when I went from 11 3/4 to 5.5. It was amazing. So if there's no tolerance for risk, then stay away from variable. And if you, there are people that will push back on that with me and say, well, I'm pretty convinced that a variable rate is good. I've done my homework and I know what's happening in the economy, and I don't think that the variable rates are going to change much. Right. And then I have them employ a strategy that reduces the risk by setting their payments as if they were on a fixed mortgage. So that means they are taking advantage of the lower rate and accelerating the pay down of the principal. So when the rates go up, then it's on a lower balance, and so it reduces the risk.
Okay.
5-year fixed.
5-year fixed, yeah.
Right now, 2.99. Actually, I have one lender at 2.94 on a 5-year fixed. Great rate.
Okay.
As compared to previous years, last year at this time, in early June, it was 2.89, and then it quickly, over a 1-month span, jumped up to about 3.49, maybe even 3.69.
So right now would be a super time, if you're thinking of buying, to lock in a rate, get qualified
huge.
by you guys, lock in the rate with a lender. If it goes down, you get the lower rate.
Absolutely.
But if it goes up, you're protected.
Absolutely.
And how long do those rate guarantees usually
120
last?
days.
120 days. So that's like 4 months.
Yeah.
That's 4 months, Lynn.
Yeah.
That's plenty of time to go buy a house.
I agree.
Yeah, especially with the inventory. There's tons to pick from.
I know, there's lots of choices
It's like
available.
going into a candy store that's full of candy and everything's on sale.
I know, it's gossip.
So, okay, so that's a good description of rates. And I recently had a client who we sold their house, and they had a huge penalty for paying out the mortgage. And we knew they were going to have that, but they had a large penalty. And what really disturbed me is that the mortgage person had just locked them in about a year and a half earlier, knowing that they were trying to sell their house, because it took them years to sell their house, knowing they were trying to sell their house, and they locked them into a 5-year fixed.
Well,
because sometimes rate's not the important thing, it's term, or the terms of the mortgage, right? Because it can cost you big.
And there are some options in that case. I've got a lot of clients now that are buying that have been in their home for 3 years or 3.5 years that I put in a 5-year fixed 3 years ago. But we're moving them we're doing what's called a blend and extend.
Right.
Right? So they're porting their existing
mortgage. That's where they're
mortgage.
going into another house.
Right.
This particular person's not going into another house.
Oh, that's not good.
And so that mortgage broker would have been better to put them in something that was open or a 1 year or something, so there wouldn't have been
even a variable.
all those years of penalty because interest differential and all that, right? So.
Yeah, in that circumstance, I probably would have put them in a variable rate instead of an open, because they would have paid higher interest rate on the open than they would in the variable. It would have balanced out.
So then it would just be like 3 months interest penalty, and there's no differential because it's variable.
Exactly.
So it's going to go up or down depending on what the mortgage market did anyways.
Exactly.
Great. Okay, so that's good information. Now, Lynn, I'm just going to remind our viewers that they're listening to the Inside Track on Real Estate with the Dekker Team. And today we have Lynn Fraser with us from More Than Enough. And Lynn's a mortgage expert. Getting you out of your mortgage expert as well.
Yeah. Financial fitness coach.
Yeah. So it's really interesting because you make money selling mortgages, and yet your goal is to get people out of their mortgages as fast as possible. So it's interesting. And it's I think why your business is so successful, because you truly care about the people you work with.
I do.
And it's not one of those those quaint sayings or whatever, right? It's you truly care. Mm-hmm. And I think the Dekker Team fits into that same mold. And one of the things we've got coming up is a way that we can care for our clients. And when some agents call their clients past clients, when they bought a house from them in the past.
Oh,
and I always say doctors are the only ones that have past clients. Because
maybe funeral parlors.
If you decide to work with the Dekker Team, for us, it's you're a client for life. When you buy a house, our relationship doesn't end.
Exactly.
We're there to support you if you need someone to work on it, if you need to get it refinanced, if you need, we'll put you with the right people. If you have questions, if you need an investment, if your kids need an investment, if your family, brother, sister, whatever needs a property, we're there to help and support. And your business is very, very similar.
We're the same way. Yeah.
Just have a slightly different product, but they go like peanut butter and jelly together, because you can't get a mortgage without a house, and you can't get a house without a mortgage unless you got a lot of cash.
That's true. I think I'm the sweet one in that mix. So.
Okay, I'll be the peanut butter. That's fine. So Lynn and I, the Dekker Team and More Than Enough, come together, and usually like 4 times a year.
Yeah.
And we put together what we call a client event. And
it's a celebration.
It's a celebration. Yeah. It's a celebration of community, because we really get to know our clients over the period of working with them, acquiring a mortgage and finding a house or selling a house. You build a relationship. You're talking about very intimate things, financing and lifestyle and housing and all of that put together. And so we create this relationship. And then one of the struggles I know I have, you probably have it as well, is people are busy, we're busy, and we don't connect with those people as often. And there's almost like a separation, a postpartum separation, because when we're working with them, we're in contact very, very regularly. I need this, I need that. Here's your next step, and do this, and call this person. And we're in communication a lot. And then after the house purchase, and they move in, it's kind of it, right? Like there isn't that reason to be in contact all the time. And so we miss that connection, and many of our clients do as well. So we create our client celebrations 4 times a year. And we have one coming up on the 29th of June.
Awesome. It's going to be fun.
This
It's
is one of my
always fun.
favorite ones. Strawberry picking
Oh, it's
social.
a jam. See? I said I was a sweet one. So you
Yeah,
make strawberry jam.
you can make some strawberry jam, and I'll bring the peanut butter.
Okay, deal.
Okay. And so what we'd like to do, and this is a first, so people open your ears and grab your pen. This is the first time the Dekker Team and More Than Enough has offered this, because normally you have to have bought a house through us or gotten a mortgage through us to be invited to one of our events. And today what we're saying is if you've been listening to our programs,
Either program,
either
right?
one.
The Financial Fitness Show or the Inside Track.
or you come to our financial fitness classes, or you come to our investment classes, or our house buying classes, and you, or even if you haven't, but you would consider, if you were to buy a house, or a family member was to buy a house, or you were to get a mortgage or refinance, if you considered us your go-to person, your realtor, maybe you haven't used us yet, but you would consider us as your go-to person, same thing with Lynn, then we'd like to invite you out to our event to meet you.
I know, this is going to be fun.
Yeah.
So our client event, our celebration is strawberry picking. And so it's from 2 to 4 on June the 29th.
Yep, that's a Sunday.
It's a Sunday, and it's we say that we're family focused and Christ centered, and so we all of our events include family events. So bring your family, come and have some fun.
Yeah, it's strawberry picking. It's near Manotick. You're going to come. We're going to give you a basket. You're going to go get a ride back into the strawberry fields. Pick your basket, and your basket of strawberries is on us. And then if you want to buy extra strawberries or extra products, they've got pies and different things there, then you're welcome to spend on those. But you don't have to. You can come and just get your basket of strawberries for free. Say hi to us. We want to meet you. And the way to do that is to call us or email us. So you can call me at 613-860-4663 and just say you'd like to be invited to the Strawberry Social. Give your email address and we'll send you out the e-invite. And Lynn, what number are they going to call to get a hold of your team?
They can call us at 613-520-4157 or send an email to info@morethanenough.ca and let us know you'd like an invite, and we'd be happy to have you come and join us.
Okay, well, if you want to be like that, they could email me too. They could email they could email Dekker Team at chri.ca. And but call in or email us. Basically, we need your email address and your consent to communicate with you, because the laws are changing.
Yes.
On July 1st, if we don't have a written consent to email you, and sometimes we'll email updates or things like that, or invites to our next event and that kind of thing. So just in your email state, you authorize us to communicate with you via email, and then we will send you out the invite to our Strawberry Social. It's going to be a hoot, and we pushed it back. Normally we would be a week earlier.
Hoot.
A hoot.
A hoot.
A hoot.
Okay, good.
Hoot, hoot. Lots of fun. That means lots of fun, Lynn.
Okay.
Normally we would have been a week earlier, but with the cool weather and the slow start to spring and everything, we're pushing it back to.
I know, we're ready to celebrate
We're
now.
guaranteed strawberries June 29th.
I know, we're ready to celebrate.
My farmer lady said guaranteed great strawberries June 29th. So
Awesome. So June 29th from 2 to 4.
okay, so what number are they going to call or email?
613-520-4157 or email at info@morethanenough.ca.
Okay, or you can do 613-860-4663, and the email is dekkerteam@chri.ca. Now, Lynn, I want to talk about a little property. Well, I say little, it's quite nice. It's very cute. Some people are spending this on a townhouse, but this is a lovely single home in Katimavik. You know where Katimavik is?
I do.
Yeah, it's a
good area.
beautiful area of Canada. Nice mature area. It's a single home, single car garage, 3-bedroom. Has a nice little family room off the kitchen. New hardwood floor put down. Newer windows. Very, very well maintained home. $327,000.
No way.
Yeah.
That's awesome.
That's the price of a townhome out there, like a a little bit bigger townhome, similar size, would probably be around that same price.
Would it be a great investment property?
It could be.
Or a good family home?
Good family home.
Okay.
Yeah, it's very, very well maintained. And actually, this property, if you are a hobbyist, you like woodworking or whatever, maybe auto mechanics or whatever, it's got a single car garage, but that garage has upgraded lighting, upgraded electrical, and insulated garage door. So it could be that extension to your house that you need for a hobbyist. So this is a great property. So give us a call if you're interested in that or any other property. There's about 8,000 homes for sale right now on the market.
Awesome.
So lots to choose from, and the Dekker team can help you narrow down to the right one. 613-860-4663. That's 613-860-4663. And we would love to help you and your family find the next home or get out of the one you're in if there's a problem. Or maybe you need the right size, your house is too big or too small. We can do that. Or maybe it's too much maintenance, you need to move to a condo. We can handle all that. And Lynn Fraser and her group can certainly help you with any of the financial details.
Absolutely.
Yeah, so we're looking forward to connecting with you, hopefully at the Strawberry Social.
That'd be awesome.
Yeah, by the way,
Welcome.
operators are standing by. That would be our great team, actually.
Yeah.
When the phones start ringing, they don't actually know we're doing this. So when the phone starts ringing, make sure you tell them that you're calling to get registered for the Strawberry Social. And again, that number is 613-860-4663 for the Dekker team. And we're happy you joined us on the Inside Track on Real Estate. Until the next time, bye for now.